Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So this is going to be a Q&A video. We're going to be answering your questions from the previous Q&A video that I did. So if you want to have your questions answered on the next video, I'm going to leave a comment down below, and you'll just need to basically reply to that comment, and those will be the questions for the next video. So let's get straight into it. First question here is from Lachlan, and Lachlan is basically asking about how PE ratios and growth rates tend to be associated with each other. So in the previous Q&A video, I mentioned that I use 2 times the growth rate as an approximate kind of rule of thumb to estimate the PE ratio that a company should be roughly trading for. Very rough rule, but it's something I use to more just figure out whether I should just throw companies away and not spend any more time looking at them quite quickly. And Peter Lynch basically mentions in his book, One Up on Wall Street, which you should definitely read if you haven't before, that he tends to use 1 times the growth rate as a good kind of starting point for that kind of thing. So Lachlan's basically asking what my thoughts are on that. Essentially, I'll talk you through where 2 times the growth rate comes from. So that's basically just looking at a very, very long-term history of stock market data. So over the past century, the stock market has grown at around 8%, and it has traditionally traded at around 15 times earnings. So near enough to about 2 times the growth rate. So that's basically where that comes from. If you can find something at 1 times the growth rate, it's probably going to be much more attractive than something at 2 times the growth rate. So the lower the better, obviously, with those sorts of things. But it's just a rough rule of thumb. The other thing with Peter Lynch is he was investing through a period of time where interest rates were quite a bit higher than they are today as well. So it wouldn't be uncommon to find things trading at much lower PE multiples, even if they were faster growing companies. So that's my thoughts on that. Martin asked, unrelated to this video, I'm wondering if I tell a broker to buy a stock for me, where is that registered? Is there a database at NZX that keeps track of it? What happens if I change broker? How does the new one know what stocks I have? Sure. So I have some experience with changing brokers and transferring shares across. So on the NZX, there are basically 2 what are called share registries. There is Computer Share and the Investor Center. So when you first buy shares in a company that uses one of those 2 share registries, you should get some mail with login details where you can manage basically what stocks you own, and that's where everything that you own is basically tracked, is in one of those share registries. And then when you change brokers, so I haven't actually changed brokers on the NZX or ASX before, but I have changed from ASB to Hatch Invest in the States. And the process basically was, I asked Hatch, how do I transfer the shares that I have in ASB over to Hatch? They gave me some forms to fill out, and it was a pretty straightforward process. There were some fees actually from the bank end as part of that, which I remember not being particularly happy about at the time, but that's basically what the process looks like. So it is fairly straightforward. Just ask your broker how to go about that, essentially. Jay Nadler asked, do you use Google Sheets / Google Finance to track shares? I'm failing to tweak my spreadsheet so it pulls the NZX and ASX shares. Grateful for any pointers. So I don't. For a long time, I had a behemoth of a spreadsheet that I was updating every month with my portfolio. It did get sort of more and more complicated, particularly when I started investing outside of New Zealand. So when I had to start trying to account for exchange rates and that sort of thing, and I also wanted to account for dividends with my returns and that kind of stuff. So I don't use that anymore. Instead, I use Sharesight. It makes all that stuff a whole lot easier. And plus, it updates everything automatically. So obviously, one of the big downsides with a spreadsheet is that you actually have to physically go in every month and kind of update all the numbers. So without blowing my own trumpet too much or anything, my time is becoming more valuable. So the less time I can spend digging into spreadsheets and the more time I can just spend doing things productive like making these videos for you guys and that kind of stuff, I'm all about that. So I use Sharesight basically to track everything at this point, and I am actually a Sharesight affiliate as well. So I'll leave a link down in in the description if you're interested in checking that out. If you do go ahead and purchase a subscription, if you use that link, you'll actually get 2 months free. So go check that out if you're interested. There's also a free version, which I used for a long time, which you can use if you've got less than 10 stocks in your portfolio and you don't want the sort of more advanced tax reporting and multiple portfolios and that sort of thing. So that is what I use to track my portfolio. Minnow Kim asks, hi Tom, how can you buy Google or American shares in New Zealand? You'll need to find a broker that has access to the US markets, and for me I use Hatch Invest, but there are a few out there, so have a bit of a Google, but I personally use Hatch Invest, and they've actually just recently dropped their fees down as well, which is quite nice. I've got no affiliation with Hatch or anything like that. I just like what they're doing, so I've been using them for a little while now. Graylin Jr. asks, hi Tom, why is ASB a good platform to buy shares with and why is it not? So I still use ASB for my New Zealand and Australian share purchases, and like I said, I use Hatch for the US. I did use ASB in the past for American stuff as well, but their fees at the time, I'm not sure if this has changed because I haven't looked at the US fees probably in the last year with ASB, but the fees are just horrendous. They're like $90 a trade or something insane like that. So that's the reason I switched away. I do still use it for New Zealand and Australia, and they basically have a $15 to $30 per trade fee depending on how much money you're putting into a particular investment. There's probably cheaper options out there, to be perfectly honest, but I trade fairly infrequently, so I don't place orders very often. And when I do, the $15 or $30 fee is not usually a significant percentage of the amount of money I'm putting into one particular stock. So that's what I've been using forever basically, and that's I continue to use it. It's reasonably easy setup, and obviously the advantage with a bank is if you do ever have any issues, you can literally walk into a branch and try to sort those issues out. So that's what I'm doing there. Chris Taylor asks, what are you benching at the moment? So I haven't touched a weight in a few weeks with the current lockdown, which is but unfortunate. It's going to be a bit of regression, and I'm going to struggle for the first few sessions back to get back to where I was. I'll put up a video somewhere here. My best ever bench press in a competition is 157.5 kilograms. As you'll see in the video, it moved pretty well. There might have been more in the tank, but yeah, that is my best ever bench press. Okay, so Timothy William asks, I'm hearing different philosophies about investing in fundamentally sound companies when stocks are falling at this rate. Number one is don't try catch a falling knife and wait till the market has bottomed and started showing bullish technicals. Number two is buy stocks at margin of safety prices, and if it keeps going down, then keep buying. Given that I have a finite amount of cash, I found it hard to determine how much cash to deploy, at what discounts to intrinsic value without having to estimate a bottom. How do I determine how much cash to allocate, what discount to intrinsic value, etc., etc. So bit of a big question and a hard one to give a really specific answer to. I would say for me personally, and this is obviously going to vary with everyone, but for me personally, I'm looking for at least a 50% discount to intrinsic value most of the time. And I've made a video, I think it's called Monish Prabrai Cash Allocation or something like that, which sort of details at which thresholds to intrinsic value I start to put more of my available cash to work. So I recommend checking that out. Basically, I would invest up to 75% of my portfolio, not in one stock, but across a group of stocks if I had enough businesses that were half off, 50% discount, and then I would start to put more of my cash to work after that point if I could find companies with a greater and greater discount. So that's kind of the way I think about it. I do not buy into the don't catch a falling knife and wait for technical signs type stuff. At the end of the day, we're buying businesses, and if you can get them at what is an attractive price, I think you should go for it. That's just my personal opinion. And if it goes down beyond that point, like you mentioned in your comment, it's an opportunity to buy a little bit more. So usually I basically figure out the total amount of money I want to put into a stock. I generally chop that dollar figure in four and buy it in kind of four chunks. Typically I've done that kind of like a month apart. In situations where the market is coming down more quickly, I'd probably be tempted to shorten up the length of time it takes me to get into a particular company, but that's kind of the way I think about it. And the final question for today's video is from Jam. What do you think about investing in a company like Carnival Cruise Lines with everything that's going on in the world at the moment? So obviously every financial YouTuber under the sun has made a video on CCL, so I'm sure you've got plenty of opinions already. My opinion's basically this. So I think if Carnival Cruise Lines can get back to some level of normality over the next couple of years, you're probably going to get a pretty nice pop from what is a very beaten up stock at the moment. That said, what you end up with afterwards is, in my opinion, a pretty mediocre business. So you're in a business that has high capital expenditure, lots of competition. There's not a huge number of players in that game, but there's not a huge amount of brand power as far as I can see between different cruise liners. And what that does is it generates sort of like a race to the bottom with pricing a lot of times. So that can squeeze margins. It's very cyclical, as we're seeing at the moment, not just because of the illness and lockdowns that's going around, but it's not a necessary item to spend money on. It's not underwear and toilet paper, you know. So it's one of the first things that people will drop out of their budget if money does become tight and people start losing jobs and that sort of thing. So it's not the type of business that I'm a huge fan of. I think, like I said, there is a potential to get a big pop out of what's a very beaten up stock, but I don't think the risk reward, for me personally at least, is that attractive. One of the interesting things I found though is CCL has obviously raised some money through both taking on debt and through issuing new shares, I believe as well. And it's pretty crazy to me that even though CCL are going to have to pay quite high interest rates on those loans that they've got, it's pretty crazy to me that they've been still able to get loans in the first place. It kind of shows that people will lend money to anyone in this day and age. So that is my thoughts on CCL. And that's all the questions we have for today's video. So if you're interested in getting your own question answered next time around, definitely drop a comment with your question down below. That's all from me today. So I hope you enjoyed the video. If you did, hit like, hit subscribe, and I will see you in the next one. Cheers.